Hi, I'm Steve Strazza, and I'm here with JC Parets, founder of Allstarcharts.com. Today, we want to talk to you guys a little bit about U.S. interest rates. JC, I know you do a ton of intermarket analysis and ratio analysis in order to provide an insight as to the direction of interest rates. Tell me what you're seeing in these ratios right now and what they mean for the direction of rates in the coming weeks to months.
I'm glad we're having this conversation because I get asked all the time, JC, why am I looking at copper-gold ratios? And why am I looking at regional banks versus real estate investment trusts? And why we're looking at utilities when we're really just looking to see what we're going to do with the bond market and what interest rates are doing. And it's really interesting because what the bond market is supposedly the smartest market on earth. But what we want to see when interest rates are moving is, well, are commodities suggesting the same thing, number one? And number two, is the stock market suggesting the same thing? Or are we getting differentiating views? So let's take it back to the fourth quarter last year. US 10-year yields were getting above 3%. Everyone's getting all excited, right? This is what? End of September, beginning of October 2018. But what was happening? Was the stock market confirming what the bond market was doing? Was the commodities market confirming what the bond market was doing? And I would argue that they were not. So to answer your question, what am I looking at? When the market thinks the rates are going higher, there's going to be a sympathy bid in regional banks, which supposedly do well in a rising rate environment. But let's think about what the market is going to do if they believe that interest rates are going lower, right? Fixed income investors are not able to get their yield in the bond market. So they have to go to the stock market where they pay higher dividends in areas like REITs, areas like utilities, for example. So you're going to get a sympathy bid in those areas if the market thinks that rates are going lower, right? Particularly on a relative basis. So when you compare regional banks, which tend to do well when the market thinks rates are going up, to REITs and UTs that tend to do well when the market thinks rates are going lower, you compare those and they look exactly like the US 10-year yield. Same thing with copper gold. The copper gold ratio, go back, it looks exactly like the US 10-year yield. This is copper as the numerator and gold as the denominator. So as rates in the fourth quarter coming into October were getting above 3%, making new multi-year highs, we were getting lower highs in the regional banks versus REITs ratio and lower highs in the copper versus gold ratio. So that divergence was suggesting, man, if we lose 3% at the beginning of October, we need to flip the book long bonds. And we were pounding the table then to be buying bonds in the fourth quarter, and that worked out real well. And it had more to do with the intermarket relationships than they did bonds on an absolute basis.
So what are you seeing? Those ratios were great indicators in Q4, is what you're saying, right? They basically indicated that rates were not going to hold that key 3% level and eventually roll over. What are you seeing in those same ratios right now? Are they showing divergences as rates are now at a near-term bottom?
Yeah, I think so. It's actually the exact opposite. With US 10-year yields making new lows recently, what are we seeing in the stock market? We're seeing higher lows in utilities on a relative basis. We are seeing higher lows in the regional banks REITs ratio. So in all of the areas that should be outperforming as rates make new lows, things like utilities, things like REITs, we're actually seeing underperformance. So the stock market is quite frankly not agreeing with what the bond market is doing. So if you turn our attention to the commodities market, yes, copper made new lows relative to gold. So the copper gold ratio did somewhat confirm the new lows in rates. But if you take a look at that copper gold ratio specifically, I gotta tell you, I'd much rather be a buyer of that ratio than a seller.
So the stock market ratios are definitely showing a divergence as rates move lower. They're bottoming and look like they're about to move higher. But what you're saying is the copper to gold ratio still maybe not quite there yet. So commodities are still not quite signaling that risk appetite that we want to see in order to lead rates higher. On your conference call this week, you talked about commitment of traders data and how commercial hedgers are super net long copper right now. I think their longest level since 2016. While gold, it's already rallied pretty nicely for the past few months, and you're not seeing as much in terms of positioning from the commercials there. Are you anticipating a little bit of a bounce in this ratio to finally signal and be the last feather in the hat for what you want to see for rates to bottom here and move higher?
I do. I'm seeing a lot of things. Like I said, if you look at the copper-gold ratio specifically, while it might not be diverging with U.S. 10-year yields like the stock market ratios are, we are seeing bullish momentum divergences on that ratio specifically. So with new lows in the ratio, we're seeing higher lows in momentum. So we're seeing a divergence within that specific ratio, not so much against yields. And then, like you said, good call, when you're talking about the positioning, right now, commercial hedgers, the smart money, are incredibly long of copper, and the speculators, the dumb money if you will, are historically short. So the positioning right now is set up for a copper squeeze, and I think that that's good for the ratio, which to me would confirm the divergences we're seeing in the stock market, sending rates substantially higher and bonds much lower. So I think the trade is very simple. If we're above 2%, which by the way, this 2% on 10-year yields was the low a couple of years ago in 2017. So we've seen support here before. If rates are gonna go higher and bonds are gonna sell off, this would be a perfectly logical place for that to start. So if we are above 2%, I think we need to be shorting bonds, no question about it.
So what I'm garnering here is that you look at a ton more than just the bond market to determine the direction of yields and bond prices. This might have some reason to do with why you won the technical analysis awards for fixed income. Tell us, are there any other ratios or is there any other type of intermarket analysis that you do in order to provide insight for yields?
I appreciate that, Steve, and that was really humbling. I've never really won a technical analyst award before, so that was great. I've been following these awards for 10 years. I've been a big fan of a lot of prior winners and winners this year as well in some other categories. And then when you look at the list of judges, I mean, some of these were idols of mine when I first got into technical analysis. Guys like Martin Pring and Larry Williams and others as well, Connie Brown, they're all judges. So that was really, really cool. And yeah, I mean, I'm very lucky that I was, maybe trained the right way early in my career to look at things from an intermarket perspective. And yes, I think that gives us a huge advantage over others looking at these intermarket ratios versus those who don't look at them. And yeah, there are other ratios I look at, for example, one last example I'll give you guys is the TIPS, right? Yep. The inflation protected treasury securities. We compare those to the non-inflation protected treasuries to see what the commodities market is pricing in for inflation, right? Because in theory, if rates are going up, they're pricing in some sort of inflationary forces. So that's another one. And we look at others as well that we'll keep behind the scenes for these purposes.
All right, well, thanks so much, JC. It was great chatting, and we'll check back in next week for more.
All right, adios.